David Walsh spent 40 years as a mechanical engineer at the same manufacturing company in Pittsburgh, Pennsylvania. He retired at 67 with 4 retirement accounts, an old 401k from his first job, a second 401k from a middle-career employer, his final employer 401k, and a traditional IRA from earlier rollovers. About $1.1 million across the 4. He used the same regional financial advisor for 18 years. David turned 73 in March of this year. His advisor told him exactly what most retirees hear. You have until April 1st of next year to take your first required minimum distribution. So David did what sounded like the smart move. He deferred. 1 more year of tax-deferred growth. 2 years later, David received 3 pieces of mail. An IRS notice with a $9,000 excise tax penalty. A Medicare premium adjustment letter showing a $280 monthly surcharge for the next 12 months. And a corrected tax return from his CPA showing he owed an additional $14,000 in federal income tax he had not budgeted for. His advisor never mentioned 3 rules that, when stacked together, turned a smart deferral decision into a cascade of penalties. The first rule is about when the First-RMD actually creates a double tax year problem. The second rule is about how 401k RMDs cannot be aggregated the way IRA RMDs can. And the third rule is about why a single high-income year quietly costs you Medicare premium surcharges for 2 years afterward. David's trap cost him approximately $15,000, and almost none of it was avoidable, except by knowing the rules before he made the deferral decision. This is for informational purposes only and not financial, tax, or legal advice. Please consult a qualified tax professional or fiduciary for your specific situation. My name is Robert, your guide to the retirement decisions that look smart on the surface and quietly punish you later. If this is helpful, hit subscribe. I cover the retirement tax traps your financial advisor mentions in passing, and the ones they do not mention at all. Today, I am going to walk you through exactly what the First-RMD Deferral trap is, and why the April 1st deadline most retirees love can actually cost them. I am going to explain the 401k aggregation rule that retirees confuse with the IRA rule, and the 25% excise tax that follows. And I am going to show you the Medicare surcharge cascade that hits 2 years after the deferred year, and the 4-word strategy that closes the trap entirely. 3 layers. 1 bad year. By the end of this video, you will know all 3 by name. Trap Layer 1. The First-RMD Deferral. Under Secure Act 2.0, signed into law in December 2022, the required minimum distribution age was raised from 72 to 73 for retirees born between 1951 and 1959. For retirees born in 1960 or later, the age moves to 75 in 2033. The first rule that surprises retirees. When you reach your RMD age, you have a one-time option to defer your first RMD all the way to April 1st of the following year. That sounds like a gift. 1 more year of tax-deferred growth, 1 less tax bill in the current year. Most advisors mention this as a benefit. Here is what they do not always mention. If you defer your first RMD to April 1st of the next year, you must still take that year's regular RMD by December 31st. So in that 1 year, you take 2 required distributions, your deferred first RMD plus the regular second one. 2 RMDs in 1 tax year. For David, that meant about $48,000 of deferred 2026 RMDs, plus about $50,000 of 2027 RMDs, $98,000 in distributions in a single tax year. His normal retirement income was around $130,000. With the double RMD stacked on top, his 2027 modified adjusted gross income climbed to approximately $228,000. That number, $228,000, is the income that Medicare uses 2 years later to calculate his and Patricia's Part B and Part D premiums. We will come back to that in Layer 3. For most retirees, Deferring the first RMD makes sense only if you have a specific tax reason, a major one-time deduction in the deferral year, a temporary low-income window, or a planned charitable distribution offsetting the doubled distribution. For everyone else, taking the first RMD on time, in the year you turn 73, is almost always the safer path. Trap Layer 2. The 401k Aggregation Trap. This is the rule that hits the most people because it sounds counterintuitive. With traditional IRAs, the IRS allows you to aggregate your RMDs. Under Treasury Regulations Section 1.408-8, if you have 3 traditional IRAs with RMDs of, say, $4,000, $6,000, and $8,000, you can take the entire $18,000 from any one IRA. The IRS does not care which IRA you draw from, only that the total is taken. 401ks and other qualified plans are different. Under Treasury Regulations Section 1.401A9-8, RMDs from each 401k plan must come from that specific plan. You cannot aggregate across 401ks the way you can across IRAs. David had 3 401k accounts. An old one from his first job, around $180,000, a middle career one, around $240,000, and his final employer's 401k, around $410,000, plus the traditional IRA. David, hearing about IRA aggregation from a friend, assumed the same logic applied to all of his retirement accounts. He took his entire RMD from his largest 401k, the easiest one to access. He thought he had handled it. The IRS view. He had taken 0 from his old job's 401k and 0 from his middle career 401k. Each had its own RMD requirement of about $8,000 and $10,000 in the doubled year. Total missed RMDs across both plans for the 2 stacked years, about $36,000. Under Internal Revenue Code Section 4974, the excise tax on a missed RMD is now 25% of the missed amount, down from 50% before Secure Act 2.0. Secure Act 2.0 also added a reduced 10% rate if you correct the missed RMD within 2 years. David's penalty at the default 25% rate, $9,000 on the $36,000 shortfall. His CPA caught it and filed for the reduced 10% rate within the correction window, bringing it down to about $3,600. Still real money, and avoidable if he had known the rule. There is a subtlety here worth pausing on. The IRA aggregation rule and the 401k non-aggregation rule are not symmetric. You also cannot mix them. An IRA RMD cannot satisfy a 401k RMD requirement, even if the dollar amount is the same. They are separate buckets. So if you have 1 IRA and 3 401ks, you actually have 4 separate RMD calculations and 4 separate distribution requirements, not 1. The cleanest way to think about it, every 401k is its own island. Every IRA is part of one shared continent. You can move money around the continent freely. You cannot use the continent's money to satisfy what the islands owe. This is exactly why so many retirees with multiple old 401ks get caught by surprise. They retire, they accumulate plans across jobs, they hear RMDs aggregate from a podcast or a friend, and they apply that rule to their entire retirement picture. The IRS does not care what you thought. It only cares whether each plan's required amount actually came from that plan. Trap Layer 3. The IRMAA Cascade. Medicare Part B and Part D premiums are not the same for everyone. Above certain income thresholds, Medicare adds a surcharge, the Income-Related Monthly Adjustment Amount, or IRMAA. The surcharge is set by your modified adjusted gross income from 2 years ago. For 2026, Medicare uses your 2024 income. For 2027, your 2025 income. For 2029, your 2027 income. David and Patricia's normal joint magi was around $130,000, comfortably below any IRMAA threshold. But because of the double RMD year in 2027, their 2027 joint magi hit approximately $228,000. When 2029 arrived, Medicare looked at the 2027 income and applied the corresponding IRMAA tier. For a joint magi in the $200,000 to $250,000 range, the Part B surcharge is approximately $280 per person per month, plus an additional surcharge on Part D. For David and Patricia combined, that was about $560 a month in extra Medicare premiums for a full year. Approximately $6,700 in IRMAA surcharges, applied automatically, with no separate notice except a single CMS letter mailed in late 2028 telling them their 2029 premiums would be higher. This is the cascade. The deferred First-RMD created a high-income year. The high-income year triggered IRMAA 2 years later. The IRMAA surcharge hit 1 year, and David never connected the dots between his 2027 deferral decision and his 2029 Medicare bill, until his CPA explained it. Now the fix. The 4-word strategy that closes the trap. The 4 words: consolidate before you start. If you are within 5 years of your RMD age, the single most powerful move you can make is to consolidate your old 401ks into a single traditional IRA before RMDs begin. 2 reasons. First, traditional IRAs aggregate. 3 IRAs become arithmetically equivalent to 1 IRA from the RMD perspective. Second, IRAs typically have more flexible distribution mechanics than 401ks. Easier to use a qualified charitable distribution to satisfy your RMD if you have charitable intent, which I will explain in a moment. If you have already started RMDs and you have multiple 401ks, calculate each one separately. Do not assume aggregation. Each plan's RMD must come from that specific plan. Keep records. If your first RMD year is approaching, think carefully before deferring. The April 1st next year deadline is technically allowed, but unless you have a specific tax reason, a large one-time deduction in the deferral year, a planned charitable strategy, or temporarily low income, you are likely better off taking the RMD on time and avoiding the double stack. And finally, the Qualified Charitable Distribution, or QCD. Under Internal Revenue Code Section 408, subsection D8, if you are 70 and a half or older, you may donate up to approximately $108,000 in 2026 directly from your IRA to a qualified charity. The QCD counts toward your RMD requirement, but does not count as taxable income. It bypasses both the income tax and any potential IRMAA cascade. For retirees with charitable intent who do not need the RMD income, QCD is the cleanest escape from the entire trap structure. A few details about the QCD that matter. First, it only works from IRAs, not from 401ks. So this is another reason consolidation matters. If David had rolled his 401ks into his IRA before age 73, he could have routed his entire RMD through QCDs and skipped the taxable income spike altogether. Second, the funds must go directly from the IRA custodian to the qualifying charity. If you take the money out and then write a check to the charity, it does not count as a QCD. It counts as a taxable distribution plus a charitable deduction, which is much less efficient. Third, the QCD limit is annual and indexed to inflation. Couples can each do their own QCD from their own IRAs, effectively doubling the strategy. For most retirees with charitable intent, the QCD is not a tax optimization, it is a tax elimination. A $25,000 QCD to a church or hospital foundation removes $25,000 from your taxable income, from your AGI calculation, from your IRMAA threshold math, and from your state income tax math, all at once. That same $25,000 donation, made the conventional way, taking the RMD, paying tax, writing the check, and itemizing the deduction, typically yields half the actual tax benefit, sometimes less, because most retirees no longer itemize due to the higher standard deduction. David and Patricia are 75 and 74 now. They corrected the missed 401k RMDs within the 2-year window, paying about $3,600 instead of $9,000. They paid the IRMAA surcharge of approximately $6,700 in 2029. Their CPA helped them consolidate the remaining 401ks into a single traditional IRA in 2028, so all future RMD math is now arithmetic on a single account. And starting in 2029, they began routing about $25,000 per year of their RMD through qualified charitable distributions to their church and a hospital foundation, eliminating that portion entirely from their taxable income. Total damage from the original trap, approximately $10,300 in penalties and Medicare surcharges, plus about $14,000 in unanticipated federal income tax from the double-stacked 2027 distributions. About $24,000 that David thought he was avoiding by deferring. You are not David yet, or maybe you are, and the IRS notice has not arrived. But if you are within 2 years of your RMD age and you have more than one 401k, the time to consolidate is now. Not after your first RMD, now. If this helped you, hit the like button. It takes 2 seconds and helps more retirees find this information. Subscribe if you have not already. And if you know someone over 70 with multiple retirement accounts, a spouse, a sibling, a friend, send them this video. Today, not tomorrow. Today. Drop your situation in the comments below. Are you approaching 73 with multiple 401ks? Or have you already started RMDs and want to know if you handled the math correctly? I read every single one, and the most common situations become future videos.